Another week, another opportunity. Hi everyone, welcome to Intelligent Investing. I'm April Tan, Chief Equity Strategist of COL Financial. We'll dig into 3 key questions this week. Why did the market rally even if tariffs on Philippine exports jumped to 20%? What triggered the massive bounce in Plus and Blue? And why did consumer stocks suddenly get a boost? We also have 6 stocks to look out for later in our stock spotlight. Let's break it all down, starting with our market overview. Despite rising U.S. tariffs, the PSEI rose 1% to 6,459.88 with 151 gainers versus 118 losers. Foreign investors were net sellers, selling 799.7 million pesos worth of stocks last week after they had just bought 2.7 billion the week before. This came as President Trump confirmed new tariffs set to take effect August 1, raising U.S. duties on Philippine exports from 17% to 20%.
Do you think the Philippines should be worried about the higher tariffs?
In a way, it's worrisome. It will impact the exporters. But for the country in general, at least we're not a very export-dependent country, and hopefully the tariffs on electronics and semiconductors will stay at 0. If that happens, that's the bulk of our exports, so that will at least reduce the impact of the 20% tariff. But based on what we're seeing, it seems like what Trump is doing is that he's reducing tariffs in general, but 20% will be his baseline. As of today, that seems to be what he's doing. So hopefully 20% will be on the lower end of the range. And in a way, that will help us stay competitive. So why did the market rally? Simple. Bargain hunting. Usually, when stocks go down sharply, investors who didn't own them the first time they went up think that now is their chance to buy. Because of this, they buy the dip. Remember that 2 weeks ago, Plus fell 48% while Bloom dropped 17% on regulatory fears. That panic attracted bargain hunters, so Plus jumped 28% and Bloom rallied 11%. At the same time, consumer names like Monde and URC rallied around 7.7%. PGOLD gained 2.4% in response to a drop in unemployment to 3.9% and a recovery in manufacturing output to 4.9% in May. They might also be going up on hopes that consumer spending growth would pick up once e-gaming regulations are tightened. The bottom line, local investors bought the dip in growth and consumer-facing names, shrugging off tariff concerns for now. Locally, bank lending rose 11.3% year-on-year in May, while consumer loans grew 23.7%, showing strong domestic demand. FDIs, or foreign direct investments, in April climbed 7.1% to $610 million, led by investments in manufacturing, finance, and real estate. This goes to show our economy is trending towards the right path. And with Trump's announcement of higher U.S. export tariffs, a Philippine delegation composed of Special Assistant to the President for Investments and Economic Affairs Secretary Frederick Go, Trade Secretary Cristina Roque, and Seferino Rodolfo, Undersecretary of the DTI and Managing Head of the Board of Investments, will head to Washington to negotiate lower tariffs. So far though, our 20% rate doesn't look that bad given that most of our ASEAN peers are at 30 to 40%. There's also a possibility that tariffs on electronics and semiconductor exports will remain at 0. The main difference between today and last April, though, is that the tariff differential between the Philippines and other ASEAN countries have shrunk. In fact, tariff rates on Vietnamese exports are the same as ours. The lower differential will make it more difficult for us to compete with our ASEAN neighbors. Overall, we're seeing solid domestic momentum, so far offsetting the negative impact of export headwinds on market sentiment. Now on to our stock spotlight. Plus stole the show as the most actively traded stock. After its crash 2 weeks ago, it surged on bargain hunting helped by the announcement of a 6 billion peso share buyback, about 4.5% of its market cap, showing management's confidence. On the flip side, regulation risk is still real. The BSP, DOF, and senators like Gatchalian and Zubiri are pushing bills ranging from age checks to outright bans, tightening of rules, and funding limits. Pancor even ordered operators to remove gambling-related ads by August 15. The BSP also released a draft circular that will make it more difficult for Filipinos to play. President Marcos said he's open to taxing and regulating e-gaming, and NEDA confirms the tax feasibility. But infrastructure to enforce such taxes isn't ready yet. So while valuations seem attractive, Plus remains a highly risky, very volatile play. We're still cautious. Our next stock is SM Prime, which has launched its new luxury residential brand, Signature Series. Its first project is a 284-hectare development in Susana Heights, with lots starting at 100 million pesos for 750 square meters and up. The move addresses their residential business problem and allows them to tap into high net worth buyers who are upgrading their homes. With that, SM Prime shares rose 4.7% last week. We currently have a buy rating on SM Prime. Another compelling story is JG Summit, a conglomerate that's been undervalued for quite some time, but all signs suggest it's turning the corner. Last year was tough, but management took decisive action. In January, its perennially money-losing petrochem arm JGSOC indefinitely shut down commercial operations. As a result, JGSOC's EBITDA losses improved to 700 million pesos in the first quarter of 2025 versus Q1 2024's 900 million peso loss. Meanwhile, URC, RLC, and Cebu Pacific are rebounding strongly. URC benefited from its sugar business turnaround starting Q4 2024, while its domestic branded business started to recover in Q1 2025. Benign inflation and falling coffee prices are expected to help earnings recover even faster. RLC is also expected to see improvement with lower mortgage rates, which is expected to help address the condo oversupply problem. Cebu Pacific is gaining from cheaper oil and a stronger peso, both hugely positive for its cost structure. Valuation is compelling. JGS now trades at just 6.8 times PE, far below its 10-year average of 17.6 times. It is also trading at a 50% discount to its market-based NAV. And on top of that, JGS also delivers about 2% dividend yield. In short, JG Summit may be writing its own comeback story. With core losses cut, improvements in earnings, and a deep discounted valuation, the stock has what it takes to outperform the market and expectations heading into the second half of 2025. That's it for this week. Despite tariffs, resilient local growth and tactical buying drove the market higher. But stay alert, regulatory risks in e-gaming and export headwinds could change the narrative. This week also marks the start of the second quarter earnings season. In the US, the release of higher than expected inflation and retail sales could significantly reduce the chance of a Fed rate cut later this month, dampening sentiment for stocks. If you found this market rundown helpful, don't forget to like, subscribe, and hit the bell so you're first to know what's moving the market. I'm April Tan. A new week is a new opportunity. Remember to stay sharp, stay selective, and as always, invest intelligently.